I'm Brett Hirsch. I'm instructor for overnightaccountant.com. And if you're familiar with overnightaccountant.com, we teach a lot on taxation and businesses, business development. But in my spare time, what I do with a lot is really not just preparing taxes, minimizing taxes, but it's a lot of economic policy. I dig into economic policy a good bit, particularly in the area of taxation. And in this political climate right now, everybody's talking about reducing taxes, cutting taxes. What's the impact going to be? I really kind of cut to the chase on this issue, and I created a spreadsheet that will allow you and us and anybody who's in economic policy and tax policy to use this little tool we created to help you actually see where the payoff is on tax cutting versus GDP growth. Real quick, the theory is you cut taxes, it spurs economic activity, it spurs economic growth. I'm not going to go to that right now in this section, or this video. I'm just going to show you how to use this spreadsheet. So, as you can see here, you've got the spreadsheet, GDP break-even analysis for reduction in tax rates. And what we're using here, you can see this section down here is highlighted 4-year. This is for a 4-year break-even. For GDP, cutting taxes, how much does GDP have to grow the 4-year period on average to pay back? But first, the break even, that means that the tax revenue collected is the same as it was before the tax cut. And then on this particular spreadsheet, we're looking at a 7-year payback, meaning that all the taxes lost from that tax cut are recouped within the 7-year period. Just like this is just like studying a business break even. Same basic theory, but we're looking at the economy as a business, which it is a giant business. So what you can do here, you can only enter where it's highlighted. All the other screens are protected. And what you can see here is, let's just say we cut personal taxes by 10%. We don't do anything with the corporate. All right, now look, cut personal taxes by 10%. Your GDP collection, your tax revenue as a percentage of GDP before the tax cuts, 10.45%. Now it's 9.59. So in order to get back to the same tax collections over a 4-year period, you're going to have average GDP growth of 2.16%. Guess what? We're already past that right now in the economy. You can see here where you have the cursor. This is your tax revenue change. This is your tax revenue. This is your GDP change, and this is in trillions. Not enough space on these things to put trillions in, but this is all in trillions. So you got to think, add about 6 zeros to this. You should be safe. So you can see reduction of tax revenue. Here's your cumulative change. You can see the break even here at year 7. So there you go. So that's a 10-year. That's a 10% tax cut. Well, if we did 25% on just personal taxes, you would have to have a 5.88% growth in GDP on average. That's a little high. That may be higher than we want to be effective. But you can play with these numbers here and see where you want. I always like to do like a 10% across the board personal tax cut and personal taxes to increase spending, and then a nice tax cut here for the corporate rate to increase job creation. And as you can see, by doing that, you need a 3.74% annual growth in GDP, which is really doable, I feel, because we're already around 3 right now. To really kick the economy in gear and get things moving. You see the numbers here, and go ahead and play with this for yourself. See what you like. You can enter your own tax cuts and see what, as Lord of the economy, what would you do? That's the question for you.